All right, today we're going to talk about something that's been kind of hiding in plain sight. It's this massive, invisible force that's been quietly shaping the markets way beyond all the headlines. We're going to go deeper than just interest rates to uncover what might be the real story of this bear market.
Yeah, you heard that right. While everyone is completely obsessed with every little rate hike, the Federal Reserve has been running a program that's way more powerful and honestly way less understood. They are literally, and I mean literally, removing dollars from the financial system. So if you've been wondering where all the fuel for the stock market went, well, you're about to find out.
You know, for decades, the main event has always been interest rates, right? It's the big lever in the Federal Reserve's toolbox. They raise them to cool things down. They cut them to get things going. It's the one thing we all watch, the thing that totally dominates the financial news.
And look, for a long time, this worked pretty well. Back in the 80s, you had this ballooning U.S. trade deficit, and the Fed just went to its classic playbook. It jacked up interest rates to stabilize the dollar. It was a blunt tool, for sure, but it was reliable. But then the financial crisis in 2008 happened, and everything changed. The old playbook just wasn't going to cut it anymore. So the Fed had to turn to something much, much more direct.
See, the real story, the one that truly matters for your portfolio today, it isn't happening in some press conference about a quarter-point hike. It's happening quietly, almost silently, on the Fed's balance sheet. And folks, this is a multi-trillion-dollar ledger that basically holds the secret key to the last decade of market performance. This is where the money got created, and as we're about to see, it's also where it gets destroyed.
So to really get where we're going, we've got to look back at where we've been. After that 2008 crisis, the Fed unleashed this policy called quantitative easing, or QE. You've probably heard it called the money printer, and you know what? That's not too far off. It's basically the central bank creating new money, digitally, right out of thin air, to go out and buy up financial assets.
And the way it works is actually pretty simple. The Fed doesn't need some giant physical printing press. Nope, they just digitally create dollars. It's like writing a check from an account that has a zero balance. They take this brand new money and use it to buy stuff, mostly government bonds, from big commercial banks. All of a sudden, those banks look at their accounts and see all this fresh cash, which then floods the entire system with liquidity and pushes investors out on the risk curve towards things like, you guessed it, stocks.
I love this quote because it just perfectly captures the magic of it all. 1 second, there's nothing. The next, abracadabra, bam, the Fed owns a treasury bond, and the market is just swimming in a sea of new dollars. The whole point was to get the economy going again. But a huge side effect was this absolutely massive inflation of asset prices.
And the sheer scale here, it's just mind-boggling. After all those rounds of QE, especially the fire hose of cash during the pandemic, the Federal Reserve's balance sheet swelled to almost $9 trillion. That's trillion with a T. That incredible flood of liquidity was the rocket fuel for the insane bull market we all witnessed for more than a decade. But as we all know, every party eventually comes to an end.
Okay, so that brings us to today and this idea of quantitative tightening, or QT. And it's simple. If QE is the money printer, well, QT is the money shredder. It is the direct, total reversal of everything we just talked about. The Fed isn't buying assets anymore. It's stepping back, and by doing that, it's pulling all of that liquidity right back out of the system.
So this is the really critical thing to get. It's a perfect mirror image. QE creates money, adds liquidity, and generally pushes asset prices up. QT, on the other hand, literally destroys money. It removes liquidity and puts downward pressure on those exact same assets. Instead of buying bonds, the Fed just lets the bonds it already owns mature. And then the money? It just vanishes from the system.
And there's this quote that illustrates it perfectly. When a bond matures and the government pays the Fed back, that money doesn't get spent or put back into the economy. It just ceases to exist. It's pulled out of the banking system and poof, gone. It's like it was pulled through a portal to another dimension. This is the ultimate tool to cool down an economy and fight inflation.
Now here's the thing. This isn't their first rodeo with QT. Back in 2018, they tried to do this, to shrink the balance sheet. And the market's reaction? It was fast and it was ugly. The S&P 500 plunged almost 18% from its high, and the Fed got so spooked they had to slam on the brakes and stop the whole program. So yeah, this history has a lot of people feeling very nervous about the much, much larger QT program happening right now. Which of course brings us to the big mystery, right? The Fed is running QT way faster now than they did in 2018. We're talking tens of billions of dollars being deleted every month. So why haven't we seen that same kind of crash? Where's the panic? Well, the answer is buried deep in the hidden plumbing of our financial system.
Okay, so to figure out what's been protecting the market, we have to dive into some of the financial system's plumbing. And that means talking about the repo market. Now, repo is short for repurchase agreement. It's basically where the big financial players go to make massive overnight loans to each other. Think of it as the critical wiring that makes sure cash is where it needs to be every single night, just to keep the whole system from seizing up.
And the amount of money flying around in this market, it's almost hard to believe. Somewhere between $2 and $4 trillion are traded here every single day. That's more than the entire yearly GDP of a country like Canada, changing hands every night. This isn't some obscure corner of finance, it's the absolute bedrock of liquidity.
So how does the Fed fit into all this? Well, it runs something called the Reverse Repo Facility, or the RRP. See, after years of QE, the system was so awash with cash that big banks and money market funds literally had nowhere safe to put it all. So the RRP became like an overflow tank. It let these firms park their excess cash with the Fed overnight, safely. And when QT started draining liquidity from the system, where do you think it was drained from first? Yep, this overflow tank. And that has shielded the rest of the market from the immediate pain.
And this is the key. Take a look at what's been happening behind the scenes. This RRP balance, which peaked out at over $2 trillion, has been steadily draining away. This is the buffer being used up. Every dollar that gets pulled from the RRP is a dollar that doesn't have to be pulled from the stock market or the bond market to make QT work. But as you can see, that safety cushion, it is rapidly heading towards zero.
This next quote really drives home just how important this has been. By giving everyone a safe place to park all that excess cash, the Fed essentially created a floor under interest rates. It was a safety net, not just for U.S. banks, but really for the entire global financial system that runs on dollars. And the RRP has been a huge part of that floor.
And look, this leads us to the brutal, simple truth of the whole situation. When that line on the chart hits zero, the buffer is gone. The overflow tank is officially empty. The floor that has been propping up the market through the beginning of this whole QT cycle, it's just going to disappear.
So what happens then? Well, without that RRP buffer there to absorb the shock, the money that QT is deleting has to come from somewhere else. The full, raw, unshielded force of quantitative tightening is going to hit the market directly. There's no more safety valve for the system's liquidity. For the first time in well over a decade, the market is going to have to stand completely on its own, without this giant Fed-sponsored safety net.
And that leaves us with one final and honestly pretty critical question. You have an entire generation of investors, of traders, who have only ever known a market that was backstopped by the Federal Reserve. They've never had to actually navigate a world where liquidity is being systematically and purposely sucked out of the system without some kind of buffer. The great unknown isn't if the buffer will run out, but what happens the day after it does? Are the markets ready for that? I guess we're all about to find out.